Welcome to the Lazy Equity Podcast, where we talk no fluff, just bricks and bucks.
Hello, buddy. How are you?
Hey, good, man. Yourself?
Good. Thank you. Another round of the Lazy Equity Podcast.
I haven't got cancelled yet.
What's that?
I haven't got cancelled yet, which is always a good sign.
No, we made it to episode 2, season 2. Fantastic. Thanks, guys. This time we're going to tackle a bit about the sort of what to not do argument of buying property and how to avoid the mistakes that a lot of people make when they're going into buying property.
Yeah, all the traps, especially a lot of conversations that we have almost every day here as well. Jumping straight into it, I say one of the first things, house and land packages. Hear that all the time.
Yeah, we do. You have my take on it. I know you do too. It's a bit of a piece that a lot of people just don't really get, I think, exposed to in the right way. And a big part of why home and land package is so attractive, maybe it's not even home and land packages, it's just new assets, some new dwellings. But we can go off on the home and land packages first. We can go into new assets afterwards. But it's, I'm sure you know and I know that they market these things so well. Like the marketing behind a home and land package is just so good. And I've got a bit of a feeling that because it's such a repeatable product, that it's so easy to market because it never changes.
Yeah.
And never changing assets mean that there's not really much scarcity around them.
Yeah, exactly. And what we do tell people often, it's developers' profits, builders' profits, agents' fees. It's usually all built into the price as well. You're paying for the end product, a premium product for a brand new property. Top of that as well, if you ever hear the words rental guarantee, I'd probably just turn around and run. It's all built into the price as well. You're paying for it. We've heard some crazy things that people are getting 5-year rental guarantees.
Yeah.
One thing that I just try to put things in perspective with people, markets like Sydney, whenever you ever heard of a rental guarantee, Perth over the last couple of years, there's no such thing as a rental guarantee because it's all about demand and supply. And if there's just not enough supply and there's huge amounts of demand, there's no need for a rental guarantee.
I can almost guarantee if you look at the fine print on those rental guarantees and what actually constitutes a rental guarantee clause, you'll be very, very afraid to move into it further. But a lot of people don't. They just see it has a rental guarantee. And then the subclause of part 2 of document 3, blah, 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 relates to the actual clause. And those rental guarantees a lot of the times are that there has to be a certain amount of time outside of the insurable period where your landlord insurance doesn't hold onto the rental guarantee. So that basically means that if you don't have income coming in for a certain amount of time, and if you have to have that insurance in place to support your rental loss, at a point in time when that stops, that's when the rental guarantee takes place. And then that rental guarantee has its own insurance clause upon it for another period of time that you don't have rent coming in. Generally speaking, that's months. And so having a rental guarantee on an asset or on a contract, on any sort of purchase on an investment property is just really smoke and mirrors. Yeah. It doesn't mean much.
100%. Even when they're building these blocks as well, these huge parcels of land they're taking, subdividing, trying to squeeze as many of these little lots in there as possible. When you think about the land that's needed to be able to do that, they're usually doing it in areas where there's just an abundance of land next to it.
Yeah.
So what's going to stop them from building another 1,000, 2,000 lots? And what's going to separate your property from the other 1,000, 2,000 that look identically the same?
And that's why they're so easy to market, because they literally look the same. They're in the same area. And they do a very good job of marketing. I wish we could do that. But we're not selling houses. And when you're going into the investment landscape and you're going up against these developers who are buyer's agents, they're not buyer's agents, so they're not property analysts, or potentially there are property analysts in the business, but they aren't really buying for you. Yeah. They're selling you an asset, and they are, it's not necessarily all true and what it's all cooked up to be. But just back to what you said there, where they start to cut up the land and put down all these different developments, or the same rather developments, and they just don't really value up in time. There's a big, we've actually seen this in a couple of markets, Berrima in Northern Territory, just in Darwin's sort of districts. There's a suburb called Berrima, and that was a it was a big acreage lot, land hold for many, many, many years. And in 2023, I believe the valuations on these assets, or rather the median valuation on those assets, was sitting somewhere around the $700,000 or $800,000 mark. Can't be exact about it, but I'll actually have a look when you start talking next. But these valuations were based on acreages, which hold value. They got bought, and that obviously hold the median, because when we buy a property, it gets sold, and then that sold asset is a comparable asset for any other properties which get sold, and that then creates the median of the valuation. What happens though, however, when you cut up all these pieces of land and from a big acreage, you are, or they are, essentially cutting them down into smaller land lots and then selling them off. Then they start to transact more, and the more transactions there are, the lower that benchmark of median gets lowered. So you're going from these high medians in acreages of land which are marketed by these developing companies to say, the values are this much and blah, blah, blah. And yes, true. But what happens after they cut it up and then they sell it off? It's the land parcel, which is price per square meter incomparable to the land that's sold from comparable sales.
Exactly, yeah.
And when you're selling an asset which is a fifth of the size or whatever it might be, you can't get the same value out of that land.
100%. Two last things before we move on to the next one as well. Firstly, there is some people that have done okay with house and land packages and all that, but it's the location. The location trumps absolutely everything. I know people that bought house and land packages in Western Sydney. Just as Sydney was booming, they've pretty much doubled in that time. And it just comes back to that fact. Is there going to be enough demand for the location that you're building? Last thing on that, have you heard about their commissions?
Oh, yeah.
It's like 8 to 15% sometimes. So 500,000 on property, 10%. They're making 50 grand commission on that. It's like,
pretty gnarly. I think sometimes I wonder if we're in the right.
Yeah, sign me up for that. I'm like,
yeah, but no. My conscience is worth more.
Exactly. It's wouldn't feel ethically right. The next one though, apartments.
Apartments are look, there's a time and a place. I don't think it's anytime soon, or has been any time recent or of recent times. The problem with apartments is that it's a stock which is very easily saturated, just like home and land is as well. The difference with home and land is that it's valued out in areas where there's no demand, because that's where they go. There's a lot of acreage and there's a lot of space for them. When you have an apartment, there's not a lot of space. It's generally in metropolitan areas, and that's why there's vertical housing, basically, because there's a need for it, because there's literally just no space for land. So it makes sense that people would think that an affordable option is going to be an apartment because it's in a metropolitan area, but I think that's where the confusion is. And there's a lot of people that fall for apartments because it's an easy buy-in. It's close to the city. It makes sense on a somewhat fundamental level. But the problem is, as soon as you put up another apartment block, when there's another 200 units or apartments going in, all of a sudden your saturation's back again to the same level of the home and land packages.
Exactly, yeah, it's just supply and demand. You'll see there's certain consistencies that we're constantly going to be talking about, especially the values on the land. And obviously when you're in an apartment block, there's 200 lots in that block that it's saying, you're one of 200 owners of that land parcel. You only own a small part of that land, and the value's really in the land, as we keep saying over and over again. If you can try and get as much land in areas where there's scarcity in land. The other thing as well, a lot of people are attracted to apartments because the yields are usually higher. They might look at the gross yields and say that's 6-7% on an apartment, which sounds attractive, but body corporate, strata fees really starts to eat into your net yields.
Yeah.
If you heard the last episode, residential property is probably never going to be the greatest for cash flow. The real money's in the capital growth. Trying to focus on as much capital growth, get good yields obviously to keep moving forward, but the real money's always going to be in the capital growth.
Yeah. Until you want to, sell down and actually retire off it.
Yeah.
Those body corporate fees are the problem, but also dealing with strata. If you own a property and you actually want to do any development to it to increase its value, it's not a fun process going through that approval process. I mean, you've got strata to go against as well as council. In a lot of instances, which just is such a headache. And it takes it down to sort of that townhouse format as well, where you've got anything that's attached to a strata is just going to be a real big headache. You want as little effort and friction on the approval process to increase what you should have absolute right to increase the value of.
Yeah, it's your place.
It is your place.
100%.
You know, just sharing it with other people makes it just really difficult.
100%. One of the big key selling points for apartments is the price point.
Yeah.
And kind of roll straight into the next one, just collecting cheap properties. The reason why I say collecting, it's not how many properties you have, it's the results they bring you. A lot of people fall into the trap of being a property collector rather than a property investor.
Yeah, I like that. You said that last episode, and actually, I've taken that with me.
It's going to keep reusing it. But it's one of those things, we see so many people, they say they've got 13, 14 properties, and they're buying these extremely rural areas, 1-bedroom apartments in central Queensland and all that. Yields look good, but they're getting no growth at all, and they just constantly keep collecting these properties.
And a lot of the times those low asset properties where you've got high yields and they are attractive, they're in those areas where there's just not a diverse economy to actually stimulate the growth over a long term. Generally speaking, single economic industry areas, usually mining. Not to say that's always the case. You know, sometimes it's offshore agriculture or onshore. It could be a couple of different variants. It could be military. But the bottom line of it is that if you are buying cheap and there's a high rental return on it, it's generally because that's not necessarily the first place of living for that tenant. They're generally probably going to be a FIFO. Yeah. Where they're flying in, flying out, and they're paying a short-term rental for the 2 weeks that they're there, and then the other 2 weeks that they're out there, somebody else is paying a 2-week rental. But it works better for them. And so sometimes, you know, you might be having multiple tenants in your house is not ideal. It's not always the case, obviously, because, you know, you don't want to have a complex lease structure with the business that owns the industry that's actually running the area. But it is possible that you actually take the lease out underneath the business rather than the tenant, and then the business leases it out to their FIFOs in and out. We've done that a couple of times for some clients that were buying up in Rockhampton a while back. It's probably one of the last houses in that format in that area. But the difference there is that Rockhampton actually has a diverse economy these days, where they used to not have as much of a diverse economy. So, you know, I'm sort of segueing, and not really segueing, but I'm kind of just going around a bit of a circle here. But the cash return on a lower performing asset or a lower priced asset is kind of what attracts investors to buying these properties. But the lower performing or the lower value asset there is generally not going to grow up in value because of the economics around it. Yeah. And if it doesn't, then you're pretty much not really moving forward in your progression. Again, you're collecting properties.
Exactly. You're just putting the handbrake on. And what I constantly say to people, property's only worth what someone's willing to pay for it. And the reasons these price points are so low, people are just not willing to pay, or they can't afford it in those areas as well. It's about having an area with multiple economic drivers. Great acronym is PI, Population, Infrastructure, Employment.
Oh.
With that being said, it's just, is there enough work in these areas? That's why they're so cheap. A lot of people can't afford those areas. It hits that affordability limit pretty quickly, and it just sits around that 200,000 for the next 10 years. People don't factor in inflation as well, so it is actually depreciating when you look at it from that perspective.
I like that. PI. Population, industry.
Infrastructure, employment.
Infrastructure and employment. 3 key. I like that.
100%.
All the pieces of the pie.
Oh, shit. I'll build upon that. It's all flowing, even though we just did a whole episode about this, focusing too early on cash flow, which kind of builds into those last few we just spoke about as well. Yeah. It's about having the right strategy at the right time, focus on wealth creation before cash flow. And
yeah, cash flow, look, it's one of those things I just sort of touched on there, but it is very attractive. You just got to make sure that it's for the right reasons and it's in the right areas that are going to actually stimulate on your actual wealth creation goals. When we purchase this is going into most of the markets that we buy in, is that they are stimulated by a strong economy. But the very first parts of a strong economy and a market that's going to go up in value, if it is at a lower end, is generally that there is going to be a more attractive rental income on those assets because it is a lower cost property. And typically, if there's a lower cost property, there's a lower income generating demographic who can't necessarily afford to save up for a deposit. So it makes sense for them to then rent. But when investors see that, they will start to go into those areas because they see it being fruitful. If there is a strong and supportive economy around it. Once that interest comes into those areas by investors, that's going to then create competition and drive equity up really quickly. But then be careful, because you've bought into this market for cash flow, which then will start to slow down once it's a stimulated market only by investors. Once those investors hit their yields of, let's say, 5%, they're going to start to exit, especially at that price point. So what then is the reason of getting into that market? Because price flow or cash flow at that stage, it's going to slow down.
Yeah.
And when the cash flow slows down because the investors don't see a need to continue buying there anymore, the equity slows down. And then you've got something that's going to be a very general returning product.
Yeah.
Which doesn't really make sense to purchasing in the first place.
100%. It's one of those things. I know I said on the last episode, yields keep you in the game, but growth gets you out of the game. Yeah. It is important to get strong yields, but the real money is going to be in that capital growth until we start to change that strategy and focus on a cash flow type strategy, which is the exit plan. Going to the other end of the spectrum, which a lot of people sometimes fall victim to, is going too far negative cash flow. They've had accountants, financial advisors saying you're paying way too much tax. You need to minimize your taxes. They're going out there and saying, how can I lose as much money as quick as possible to try and get less than half of it back in their taxes?
Yeah.
And we want to try and look as attractive to the banks as possible so we can keep moving forward. Every property you buy is to get you straight into the next one after that. Yeah. The real money is trying to get into as many high growth areas as fast as possible. If we become too far negative cash flow too early, a big question we always get, are you guys buying in Sydney? I'm not saying Sydney's not going to grow. Definitely think it's a great market. It's just almost like putting a handbrake on sometimes, where you're taking out huge amounts of debt. People get stuck with their debt to income ratios, but then also how far negative cash flow it is, you do not become very attractive, especially the tier 1, tier 2, tier banks as well.
Yeah, as soon as you start putting your money into assets that are hard for you to hold, and then you have to leverage into other tiers and other lenders, you're going to be chasing your tail for a while until you actually come around right. Another part of that is also, we've been speaking about not buying too low in the market, but you're also not about too high in the market.
Exactly.
Buying the higher properties and the higher quality assets generally come at a premium price. I think we may have touched on this in the previous podcast, I'm not too sure, but we spoke about the different percentiles. Now, there's a median percentile, which is generally the middle price point of the market. The 75th percentile and above is the most expensive types of properties inside the market. Buying those properties, generally an investor would think that they are less prone to any issues, or that there's less of an upkeep requirement for the properties, which may be true, which may be correct, but you're buying at the top end of the market. And when you're buying at the top end of the market, again, just going back into what we spoke about in the beginning, that when you purchase an investment property, it gets valued against the median of the market's prices. So it gets valued by whatever other properties that are similar to it being sold. If you're buying at the top end of the market, there's a least amount of properties that are like it being sold. So you're going to be compared to the lower types of properties that are similar to it that are being sold. When I say similar, that comes down to format. So you buy a top end 4-bedroom property, let's say that property is going to cost you $900,000 in the market, or $1 million in the market, versus a 4-bedroom property, which is going to cost you, let's say, $600,000 in the market. You buy that $900K property, and there's not much transaction going on around that same bracket, but there is a lot more going around that median bracket, say the $600K mark. Every time a property gets sold, you're going to be compared to similar assets of those median qualities, because there's not enough transaction at that level. So you don't grow as quickly as what you would if you're buying at the median, or if you're buying below the median as well. Yeah,
it makes sense. It's usually how I try and break it down to people as well. If you buy a $1.5 million property, it's probably going to rent around $900 a week. You buy two $750,000 properties, it's going to rent at $700 a week. You've got the same size portfolio of $1.5 million. One's renting for $900 a week. The other one's at $1,400 a week. One makes you look a lot more attractive to the bank, so you can keep building that portfolio.
Yeah, 100%. And that's what we need. We need to build the portfolio.
Yeah.
Too many people get stuck at these things that shiny objectitis, you know, and we see it. And unfortunately, we have a bunch of clients that come through to us to help us, or help them rather, and get them out of these sticky situations. Cool. So what else do you have over there?
The last one, and this is from personal experience as well. having the wrong property manager. A lot of times people are looking around for the lowest rate, especially if you're buying outside of Sydney. Sydney, you can get property managers for that 5.5%, 6% management fees, where you go interstate, sometimes it's anywhere from 9 to 13%. Cheapest isn't always the best option.
Yeah.
One of the properties I had, this property manager was absolutely awful. Every time I went to buy another property, I said, can you send me the lease? Turns out the lease hadn't been renewed in about 9 months. When I went to sell the property years later, agent calls me up. He said, when was the last time you actually saw this property? I said, it's been years. He said, I'm standing in the kitchen. I can look straight down into the ground. There's a hole in the kitchen. There's holes in all the walls. None of the doors closed properly. There's a dog that's eaten everything. The grass is about 4 feet high here as well. Property managers are worth their weight in gold. Do not cheap out on them.
Yes, and make sure that you set your boundaries with them, I think, from the start too, because it is, property managers are very busy. And they are running around constantly trying to fix things, basically, and manage issues. I think if you set those boundaries with your property manager to let them know to help you with the clients in the right way, and the right way would be, if there is an issue, please send a video so that I can forward it off to the owner of the property. That's one thing that we've come up against quite a few times, is that our properties are managed and there's a manager that's managing these properties, but they just take the request from the tenant and they order the things that need to happen.
Exactly.
And then all of a sudden you're not just on a neutral, but you're on a negative flow. Yeah. And you don't want that. You want as much sort of ease in your property as possible. So I think communication and finding the right manager is so important to keeping your properties in a good condition and up to date. And proactive managers are just, they're worth it. They are so worth it. I've got a place up in Yeppoon, and they are phenomenal managers. We've had our tenants that have just recently moved out, and they moved out because they were actually building their house, and I took them on as a lease for 18 months, and they've finished their development or finished their build, and now they've gone into their new home, which is great. And during that time, we actually had, I think it was about 2 different applicants that my manager put in front of us, and they took them through while the tenants were there, got them to look at the properties. They were happy. They both put an offer through. Both tenants' options put the offer through. And before, I think it was about 2 weeks before vacate, they were lined up and ready to move in the day after the move out. You just don't get that often enough. And I think it's hard because they are busy, and especially in the markets that we work in, there's a lot of transaction, there's a lot of nurturing, there's a lot of activity around tenants and new properties, and it is very difficult for them. Yeah. But I think if you are going to try and create a good relationship with your property manager, to let them know, to pass the message on to your tenants of how to manage requests, because yes, there's portals and everything, that's fine, and the portals are great, but we need to understand actually what's wrong with the property, not just to take the money and fix the problem, because sometimes it's not a problem. The garage door doesn't close. Why doesn't it close? Because my thong is stuck in the in the hinge. Yeah. Take the thong out and it works. That's a true story, by the way. Literally, there was somebody's sandals were stuck in the door hinge for the garage. Crazy.
100%. It's one thing with property managers. It's such a spectrum as well. So sometimes you do have to shop around to find which one's the best in that regards. The last thing I'm going to say, this is like a bit of a tip. Don't have to do it. I remember when I started to accumulate a few properties and all that, and everything was being sent straight to me, the water rates, council rates. Yeah. At the tax time, I was trying to rush around, find everything. Tip is, if it's obviously get them all sent to the property manager. Yep. Anything under $300 maintenance, typically say, can you just fix it? Anything over $300, I want multiple quotes for that.
Except for if it's a thong and just get the videos and the photos.
Exactly. The reason for this though, at the end of the year, the property manager is going to give you your owner statement. It's going to have absolutely every single cost on that. You can just hand that straight to your accountant. It's all tax deductible. Yeah. Rather than
don't manage it yourself.
100%. And you have to go around trying to find all the different bills you've paid throughout the course of the year across multiple properties. It's way too much work, and it's so much easier for your accounting purposes.
100%. I got one actually, another one. Stay sure to who you're lending. A lot of first-time investors, when they can't get their finances together, they typically go to a second tier and then potentially a third tier because they want to try and get as much out of them that they can. Problem with that is that you then have these really high interest rates and you're stuck on a 7% interest rate or a 6.8% interest rate, 6.9% interest rate, when you really didn't need to go through that lender. Find the right avenue, find the right support, find the right financer to buy you the property that you need, and stop your expectations around it needing to be a $900,000 property. That's brand new again. So it's basically going back to those other points that we raised earlier. It doesn't have to be a beautiful property. You just have to understand the returns of these assets are there to make you wealthy. If you're putting your money into a financer who's not going to allow you to get wealthy because you're being strangled by interest rates and you're trying to get another loan for your next property, but you're being absorbed so much by this, depending on what your income is, it's not going to help you. Again, you're going to be on the back foot running in circles.
100%. Property is just a vehicle to get you to that financial goal that you're looking towards. It's just numbers on a spreadsheet. That's what we're really focusing on.
Yeah.
A lot of people do talk about cross-securitization, obviously, just so your properties aren't cross-securitized, and obviously taking each loan to a different bank, just so if anything goes wrong, they can't tap in and take the property, which is all, anything that's grouped together is tied together, is what I'm really saying.
Yeah, but you also, like, there's another side of that, you know, you kind of, it's the ease of having them together is one thing. Just that cross-securitization, you just need to be on top of it.
Yeah.
Just make sure it doesn't happen.
100%. Yeah, it's one of those things. It was something that was really kind of demonized as I started building my portfolio. Eventually, I had to start going back to the same banks. And I realized as long as I'm not going to get sued or I'm not going to default, go bankrupt, it's not the worst thing in the world. Yeah. It's just what's going to get you in the best position to keep moving forward.
Just on that, just to explain what cross-securitization or cross-collateralization is basically when the banks assume the full value against all assets and they start to lend you against the full entity as one. Essentially, that's kind of like the very basic term of it. What they're doing then is that if you try to go to another bank to value that property, which one do they value? Because the whole thing's taken as an asset release. Yeah. And so you have to then revalue everything independently, have to understand your independent LVRs, and then you can actually get a lend against it from another bank. So I guess if you ever do go into releasing equity from a property, or if you're going into rather using a property to buy another property, let's put it that way, be sure about the structures that they're doing it through, because cross-collateralization will be a very, very difficult mess to untangle when you actually want to grow and develop your portfolio with other lenders that are more attractive and more palatable to actually what the structures and the financial strategies are that you want to put in place.
Yeah, definitely. Yeah. Best workaround with this, just find a great broker that knows what they're doing. They've got a panel of banks. You go straight to the bank. The bank's just going to try and sell you their best products. If you have a great broker, they're going to look at your situation and find you the right lender for the right time in your portfolio.
Yeah. Yeah. Have you ever been involved with any cross-securitization?
I'm trying to remember. I remember I was trying to buy. So I've used multiple brokers throughout the journey, and I was really trying not to cross-securitize my properties, go to multiple, trying to buy this renovation project, had structural issues. A lot of lenders wouldn't actually lend. However, CBA, who I had my first property with, told me, we'll give you the loans for that as well. I was like, great, going ahead. I kept saying to my broker, make sure it's not cross-securitized. She's like, yep, no issues at all. Went back to CBA a couple of years later and they said, even though you got told that, it's all under CBA. If something goes wrong with one, we'll take the other. So it is something just to be mindful of.
Yeah, it is. It's not to say that the banks are bad for doing it. It's, again, they're trying to support their best products. And sometimes they are the most attractive ones to lenders. You know, I kind of got caught. No, it wasn't a securitization or collateralization at all, but it was more that I was getting lent the amount by CBA again.
Generous.
But,
They're generous.
I know they are. But they were doing it off a P&I loan only structure. They wouldn't let me go into an interest-only structure. And I think this is a lesson to be learned as well, is that it depends on what classification that property is in. Yeah. So this was it was a agricultural classification on the zoning, even though it was just fringing on residential. And it was fringing on a suburb. And it was just literally 100 meters down the road, and it was just outside of the suburban pockets, and it was a bigger piece of land, and that's what attracted me to it. But the bank actually wouldn't let me do an interest-only loan. They would only have the comfort on a principal and interest. I've taken that loan since over to a different bank, to NAB now, and that's fine. Not a problem. So sometimes get in with what you can. Don't be afraid to move it on, but be sure that the structure that they put it under is going to allow you to move it on.
Yeah, that's a good point.
And I think they were very close to tying that all together for me.
I start that again.
Yeah. That's pretty much it, I think, yeah.
Yeah, that's pretty much it. That pretty much covers a few of the traps we see people fall, I guess, victim to, that really kind of stunts their property growth, building out their portfolios as well. So appreciate you elaborating on all that.
Thank you, mate. Thanks for your time again. Always a pleasure having you in on a chat. And next week, we've actually got a guest coming in to speak all things depreciation. We're extremely excited to speak about this topic because it is one that's not known to a lot of people. Even he, the lovely Mark Mortlock from MCGQS, will admit that a tax deduction, tax depreciation rather, is not a strategy. It's a nice to have.
Yeah.
And he's going to uncover all of those sorts of questions and the nuances to understanding what a tax depreciation schedule is and how to benefit off it most, and when it's not even necessary to put in place. Guys, thanks very much for joining another episode of the Lazy Equity Podcast. Until then, we'll speak to you soon.